Good afternoon, everyone. This is Lee Martinson. I'm the Customer Success Manager here at Snap Projections. And I also have Yulia Zavisha here with me today, and she's a member of our team, and she'll keep an eye on any questions that are coming in, and we'll hopefully be able to just, answer any questions that come up and go through a bit of a demonstration of an example couple in Snap Projections and answer some of their top questions that they might be coming to you with for planning advice. Let's see. First, I just want to mention how to ask questions. So in your GoToWebinar panel, you can use the questions box to type in your question and hopefully be able to get to those immediately in the session today. And here's some of the top retirement income planning questions that you might be asked by your clients. And this is based on thousands of interviews with financial advisors and planners and investment managers. And the top questions that we're going to talk about out of these 6 today are number 1 and 2 and 6. So how much can I spend so I won't run out of money? How long will my money last? And then how much will be left for my children? We're also going to touch on number 5. I'm currently saving a certain amount of money, and will that be enough? So let's go ahead and pull up Snap Projections then. So when you first log in, you're going to come to our client list. And just one thing I'll point out before we move into our sample client for today is you always have the option to show all your clients or not show them. So you can keep this blank and just do a search. So today's client is going to be last name of Cooper. And so we're just going to pull up that single client in our list. So that's always an option that you have available. You might not have seen that before. So today we're going to look at Vance and Julie Cooper. And I'm just going to start with an example scenario that I've already created for today's webinar. So what we're going to do is go into the scenario setup and just review the information that I've added. And this is just kind of keep things a little bit quicker today. We can go through the initial data. If you want to see more about how to enter the data, we did a Q&A session last 2 weeks ago. So December, I think it was from December 2nd actually, and we have a recording of that up on our help site. So help site, you can access up at the top right. Just click help, you can go right to the help center, and the webinar section is going to be where you'll find some previous recordings. So these Q&A sessions we hold approximately every couple weeks, and we have some recordings right here that you can go to. So if I come down to the sample projections for a couple nearing retirement, sorry, I guess it was December 6th, not the 2nd, you can take a look at that one to go right from the beginning and enter the data. We can also sign up for new sessions. I haven't actually put the new one up for January, but we'll have one mid-January that will be up here shortly that you'll be able to register for. The other sections that are helpful would be the Start Here section. So along the left here, there's Start Here. And you can take a look at creating your first projection, case studies, as well as the other one that I wanted to point out was the What's New section. So again, on the left, What's New. And we have an article that details all the latest updates. And we also just released the First Home Savings Account, and we have a little video and an article right here that you can access for more information on that. So back to our sample client for today. So we have a couple, this Vance and Julie Cooper, and all we've had to enter here on the initial page is their names and birth dates and which province they live in. If I continue down the scenario setup flow here, I'm going to go to the general page next. Here, we've started the projections in 2024 because that's coming up very soon. And that's always a good idea as you get closer to the end of the year. It tends to be easier to start the projections in the upcoming year. We're going to have them retire at age 65, show their projections until they're both 100 years old. And we've set up the inflation rates with the FP Canada's default guidelines. And you can read more about that up here with our What Is This? Talking about the guidelines, and you can actually access their guidelines here. This will be updated approximately April, May every year. So there'll be new guidelines that we will also have in the software. We've adjusted those guidelines for fees, for any investment fees, so that we've reduced them accordingly where we wanted to take into account the fees. So we can also choose to go to the next page at the bottom using the next button, or again, I can use the different headings along the side. So right now we're on the expenses page, and here, if we don't know what the clients want to be spending in retirement, or what they're spending right now for that matter, then we can actually leave this blank, not blank, but put a 0 in for the amount for the combined base expense. Base expense used to be referred to as after-tax spending. If you've been a client with us for a longer period of time, we've renamed it to base expenses. And you can see wherever there's a question mark, this is going to give you a little bit more information. If you just hover your mouse over top of it, and what we're looking for here is their recurring lifestyle expenses after taxes. And this is an annual amount. So when I look at the combined amount here, so it's asking for the annual dollar amount after tax. We can make adjustments here or on the planning page directly when we get out to that page. So I'm going to leave this blank, not blank, I'm going to leave this 0 for now. You won't be able to leave it blank, but you can keep it at 0 and then we can adjust it on the planning page when we get there. I'm not going to add any additional expenses today, but this would be to track things like cars, those recurring larger expenses that aren't part of the regular lifestyle, but maybe happen every few years or every 10 years, and you just want to make a note of those larger expenses that are happening. Okay, I'm going to continue on to the income page, and here we're looking at Vance. And so we have, because it's a couple, we have both Vance and Julie. I can tell that I'm looking at Vance's page for a couple reasons. One is that Vance's name here is darker in blue, but I also have his name in brackets at the top of the page. So we're referring to Vance's employment income. It's $50,000 a year. Right now we're not choosing to index it, but I can index it if I wished. So if I did want to index it, I could delete the amount that's there, and you can see that general inflation will pop up, and this will be indexed with my general inflation setting that was back on the general page at 2.1%. In this case, I'm going to keep that at 0 right now. He's not sure about ensuring that he has a raise every year, so we're just going to go ahead and keep it at 0. This is employment income, and it is taxable. It will give him more RSP room. The from age is blank, which means it's going to start at the beginning of the projections, and it's going to go until the end of the year that he turns 64 because he's retiring at 65. If I did want to show some partial income in the year he turns 65, I can use this gear, and that lets me put in a specific date that he'll be working until. If I switch over to Julie, we can see her employment income is $110,000. Again, I've not indexed it. And then we can move on to the next page, which is their assets. So on this capital assets page, we have headers along the top, which will deal with more specific information for the assets that you enter under this table. To add assets, we're going to use this Add Capital Assets button, and these are the ones that we've already put in. So the RSP for Julie is $390,000. That's the balance as of January 1st of 2024. It's an RSP, and we have the asset allocation set up with 30% fixed income, 70% equity. So the total overall rate of return is 4.25%. They also have a joint non-registered account with $78,000 and an initial cost of $76,000, and you can adjust that amount. And in this case, again, it's the same asset allocation, and you can adjust any of these figures in this row, and whatever values you use will help calculate this total rate of return, which is, you cannot edit that value, but you edit the other values so that it's calculated for you. We also have the real assets, so the house. They have a house that's worth $561,000, and they already own this house, so we have nothing for the future purchase age. We're going to hold on to that house until the end of the projection, so the future sale age is blank as well. And it's a joint asset, and there's no capital gain tax associated with it. If I look again at the top of this table for capital assets, so right now I'm looking at the assets view. That's a summary of all of them, but I can click through to the different assets. So that there's the TFSA. I can adjust the RSP, or sorry, the TFSA contribution room for 2024. So I could say that she has $7,000 of room, for example, for 2024. Or if she's never had a TFSA and there's a lot more room, I can adjust that to the maximum. I also have RSP contribution room, and this is calculated automatically based on the initial first year's employment income by default. It's been adjusted here to what her room is, 39,800. And for RSPs, you can also choose when to convert that to a RIF. So this is the default at age 71. There aren't any locked in accounts here, so we don't have another table for those, but it's very similar to the RSP table where you can adjust the conversion age. You can also set jurisdictions and unlocking percentages on that page. Our new FHSA account, I have settings for that here as well. And I'll refer you back to that article about the FHSA to watch the video if you'd like to learn more about that. We have our employer matching, and this is if there's like a group RSP, for example, we could select that based on her employment income, that Julie is going to be contributing a certain percentage and her employer is contributing a certain percentage. In this case, it's not a group RSP, so I'm going to just enter her contributions to the RSP directly on the planning page as an annual dollar value amount as opposed to a percentage amount. But this is where you would do group matching. I can switch over to Vance and just take a look quickly at his RSP is 156,000, and he has the same asset allocation as Julie. And then we see the joint non-registered account because it's joint, so it shows up for both of them. If we continue on to the next page, we have the debts, and there's a mortgage that's $59,000, and interest rate is 3.5%. It's being paid back at $1,200 a month, and it is joint, and it's linked to their house, so that if they did sell the house in the projections, then we would be able to pay off that mortgage automatically with the surplus money available from the sale of the house. If I go next to the government benefits, for Vance, we're using the national average, what he'd expect to receive for his government benefits, and this is adjustable, as well as adjusting the annual amount. If a client is already receiving CPP, you can just put in the amount they're receiving right here before taxes. And you can also adjust the starting age. So for example, if I said I wanted Vance to wait till he's 70 and I put the amount and then I just click away from that cell, it automatically calculates the new amount, what that would be, indexed at 2.1%. So by the time he is 70 in the projections, this would be the amount indexed by 2.1% over time. For now, I'm just going to keep that at 65, and you can see the amount adjusted back down. The percentage at percent of the maximum at age 65 stays the same, so that's the national average. For OAS, we're going to assume 100% of the maximum, and that is the default. I could also adjust the starting age for that to anywhere between 65 and 70. And for Julie, she has a 75% of the maximum assumption for her, and she'll also start at 65. There are more settings along the scenario setup that I'm not going to go into in more details today, but we have insurance, education, corporations, and then some advanced settings down here, including charitable donations. But what we can do, instead of having to go through these one at a time, we can just jump right over to the planning page. So if I click planning pages, that takes me over to Julie's planning page in this case, because we were just looking at Julie's information. And while I'm on Julie's page, what I'm going to do first here is just explain this RSP contribution. So this would be, I'm just going to clear this out for a second and show you how to enter it. So she is doing RSP contributions $1,000 a month or $12,000 a year. So the method to enter those contributions. That's the one thing that's not in the scenario setup. It's going to be right here on the planning page, and that way you can adjust it year by year. You just click the amount that is showing under that contribution withdrawal column, and I type in the $12,000. I want to copy that down to age 64. I can choose to index it if I'd like to. In this case, I'm not going to. And clearing the override is only used when we want to get rid of previous contributions that we've entered. So I don't need to check that right now. I want to enter this as a $12,000 contribution. The background of the cell turns yellow, so this is indicating that I've made a change and I'm overriding what the software would have done automatically, which was to have a $0 contribution in this case. The second step is going to be to actually run the scenario. So in order to recalculate, I need to click the run scenario button, and it's turned red for me to indicate that I do need to rerun it. So when it's green, that is an indication that everything is up to date, all the calculations have been done. When it's red, you want to click that button so that the calculations are completed, and then you can take a look at what's happening in the scenario. So if we stay here on Julie's page just to start with, let's kind of go through the planning page itself. We have from the left to the right, we have the year 2024. She'll be turning 44 by the end of that year. And then we have this section called the cash flow management, or the CFM. Whenever you see an icon of some sort of like blue or teal, you can click that for more information or to actually complete more actions. So here we have information about the cash flow management. You can go to an article for help. And we've told the software that we do want to enable some automatic cash flow management starting at 65. And what that means is at age 65, we're going to enter a desired expense or lifestyle spending amount. And then automatically, the software is going to figure out, do I have to withdraw money to meet that spending target? Or is there a surplus of money? And then I'll start saving the surplus to the various assets that are available. So we're not going to do any of those automatic contributions and withdrawals until age 65. And that's the default to start the automatic CFM at retirement. And you can see that again another way under this start age column. And that blue radio button is selected here at age 65 for Julie when she retires. And what that means is before retirement, we have all of these base expense values displayed for us. And that's just how much money is left over at the end of the year. So after taxes, what's left over based on Julie's income minus any expenses that we've set up in the plan, like contributions to her RSP or mortgage payments, also taxes and CPP and EI deductions and so on. So if we kind of go left to right, we have her employment income of $110,000. She's not receiving any CPP and OAS yet. I'm just going to skip the taxable income for a second here, but she is paying into CPP and EI based on her employment income. And I will just skip those ones for a second. She's making an RSP contribution of $12,000, nothing to the non-registered account. And then we have a mortgage payment, her half of the mortgage payment of $7,200. So if I was to subtract those expenses plus her taxes, then we have what's left over is the $65,542. And we're just going to assume that all of that money gets spent. And if she's not saving it, then she's basically spending it. And that's usually the easiest way to think of things for clients who are still working, because they may not have a detailed budget that shows them what they're actually spending. And you don't need to create one for Snap to run the projections. So here we've got what's left over for her, and I skipped over the fact that there are more information available for taxable income. Again, this is a button at the top of that column, and I can click that for more information. So this is the taxable income details field. It tells me where's her taxable income coming from employment income, the investment income from her non-registered account, the fact that she's making contributions. The RSP means that she'll have a reduced taxable income. along that column, which is also the number that you see here under taxable income. And that's what her taxes are going to be based on. The total tax details will tell you the taxes for her entire lifetime, how much taxes she's paid, and in each year what the federal and provincial tax was. Okay, so the planning page at the end of the day is where you're going to be to try to find out, do we have enough money to live the lifestyle that we want, like what's projected here in the plan. So if I scroll down, I can see that at retirement right now, the base expense value is nothing. It's gone to zero. That's where we left the value at zero when we first were on the expenses page. And if she's spending nothing, then we can see this automatic cash flows has kind of kicked in, and it said, well, if you're spending nothing, then you actually have money that's left over, and we're going to save that automatically. So it's showing RSP contributions automatically based on her surplus. And these things are adjustable. You can determine, which assets you would want that surplus to go to. You have an option at the top of the capital assets section where we can turn on what's called the CFM order column. And what that does is show us the default setting. Here's the CFM order. It gives us another column. And it's just informational to say, if there's surplus money, it's going to go to a registered account first, then a TFSA, as long as you have one in the plan, and then non-registered. I can adjust that just by clicking on it, and I could change that order to a different order if I wanted to. But what we want to do in this case is make sure we have a value for some spending in retirement. Obviously, if they spend nothing, they're going to have a lot of money left over. If I come back up to the top, I've got Vance's page, which also shows his employment income, the $50,000, and his base expense, what's left over. We don't have any savings happening for him in his plan at this point, and he's not planning to make any. So that's all the inputs that we needed to do, except for their spending. To enter spending, we want to do that on the combined page. So I'm going to click combined. And on this page, there's actually a lot of information. You cannot enter contributions and withdrawals, but you can see them. If we come back over to this capital assets section, you notice that all of these headers have this arrow on them, and this is an expansion arrow. So we can expand these columns to see different information. So if I click that button, the capital assets section changed its view. So now we've got the open account, the joint account. We can see the value for both of them for all the years, and then we have each of their RSPs. So if I just hover my mouse over the name of the account, it says this is Vance's RSP and then Julie's RSP. And we have all of her contributions that are happening. So it just gives you that expanded detail, as opposed to when I collapse it again, we just see totals. So what's the total value for non-registered RSP, and what's the total contributions for the couple? So under this expenses column, we want to either enter a value that they want to spend, or we can have Snap calculate for us how much they could spend. So that was one of the questions. How much could I spend so I don't run out of money until the end of the projections? So let's do that one first. I come up to recommendations, and I can see right now that I'm overfunded. I'm retiring at 65 years old, but because I have $0 in spending in retirement, I'm overfunded. So what I'm going to do first is the sustainable spending, calculate the amount. And calculating it is just going to give us the information here on this page. It doesn't actually apply it to my scenario unless I click this button, apply and run. So this is telling me that they could spend $83,000 a year. And I can either apply that right to this scenario, or I can copy the scenario first before I apply it. But I might as well apply it right now because I have no spending at this time. So let's actually put in some retirement spending. We have $83,000 a year, and then I can scroll down to the bottom and I can see that at age 100, there's this minimal shortfall here of $6,000. It's basically tried to zero out the accounts by the end of the plan. So what's left, the total value is there's $7,000 left with a $6,000 shortfall. So that would be covered off. it's less than $10,000, it's sustaining. It's basically saying we met the conditions here for a sustainable scenario. How can we see what that final estate is? We can see, first of all, the all types is $7,000, or the real asset value, what that house has grown to. But I can also use the estate before tax column. We have this button again at the top of that, and this will show me the final year's estate. So I have the estate summary. I have a combined column for this is for both spouses in the final year, and their final estate, if they have some capital assets, then they have their house. What's the total minus any debts, that small little bit of a shortfall. Then we have got the total estate, what's the taxes owing on that estate, and then the estate after tax. And if we brought that back to today's dollars, it would be $572,000 in today's dollars. If I have other scenarios, I can choose to compare that final estate depending on other things that I might have changed in this scenario, like retiring later or starting CPP later, or different factors like that. So we were able to answer their question about how much to spend in retirement so they don't run out of money based on those contributions that they were doing initially. Another way that you could do this is taking a look at their current spending. So as a couple, they have $98,000 left in their expenses. That's what they can spend per year. And in the first year of the plan, we can use that value to say, if you wanted to maintain your current lifestyle, so you're used to spending $98,000 after tax, could you maintain that in retirement? So we could click that amount. So whether it's 0 or whatever the blue dollar value is, if I click on it, I get the ability to change it. So I can put in that $98,000 and copy down. And then again, I need to run this scenario to recalculate. And I'm going to expect now that there's going to be a shortfall because we knew that they could only spend the $86,000 a year. So as I scroll down, the shortfall on SNAP is displayed here as both pink lines in the scenario where we have a negative cash balance account. This is SNAP borrowing money for them to be able to maintain this $98,000 of spending indexed with inflation. So you can see by the time they're 86 years old, spending $98,000 today would be like spending $234,000 based on 2.1% inflation. So how much are they short each year? That's the net cash flow. And then if we were to borrow money to allow them to maintain that spending, how much would they have to borrow, including some interest, which is, there's a setting under scenario setup for the cash balance. So down here, settings, cash balance at 4.3% borrowing rate. And that's adjustable. You could change that if you wanted to. So by the end, go back to the combined page again here. By the end of the projections, they would have had to borrow $2.7 million to maintain that spending. So that's probably not what they would want to do. So we have some other options. We could look at recommendations again. And we can see that in this case, they're underfunded. And the shortfall is a certain amount of money. So we already ran sustainable, so we know what that was going to be. You have the option, you could change the age to start sustainable. So you could say maybe at age 80, they want to calculate what the sustainable would be. So they'd spend the $98,000 until age 80, whatever value we put here. And then it could calculate sustainable going forward from that point. Or we could look at retirement age, and we could have SNAP try to find out maybe how much longer would they need to work in order to reach that target spending. It may be that it's not possible to find an answer sometimes, but here they could work 4 more years, and we could apply that to the scenario. We could also calculate how much more would they need to save. And so this would be based on the fact she's already contributing $12,000 a year to her RSP. Well, let's take a look if they were able to save an additional amount, additional $20,000, then they'd be able to be funded as well. So the good part about this required savings, so I could apply this. Let's take a look at what happens. is it's telling you sort of an after-tax savings value and a before-tax savings value because it's using the capital assets that you have in your plan already. So it kept the $12,000 amount that was currently being planned to be saved, but it's also saving now to Vance's RSP, and additionally, it's saving more to the non-registered as well. So they would have to do quite a bit more savings in order to reach that target, but it will give you information based on the scenario assets that you already have in your plan. Okay, so I think we've answered, let's see now, what questions were left. We had, how long will my money last? Am I going to be okay? So we answered that one, looking at if they wanted to spend $98,000, they were only going to last till about age 86. How much can I spend so I won't run out of money? Was a sustainable scenario. And I'm currently saving a certain amount. Will this be enough? And then how much will be left for my children? We took a look at the estate summary as well. So we've been able to answer most of the questions just quickly using this planning page. One thing to note is that you can also take a look at charts. So if I was to click the charts button, this is another way to present the information that we have cash outflows. Where's the money going? If we hover our mouse over the different items, it will highlight them for us. So we have their base expenses, we have money going to taxes, their debt payments are completed in a few years, they do some savings to their capital assets, and then the total inflow is indicating that the inflow is meeting their outflow needs so that there is no shortfall at this point. We have a cash inflows chart, and this is helpful to see where's your money going to be coming from when you retire. So before retirement, we have our employment income, then we have OAS and CPP, we have the RSP and RIF income, we have non-registered income, and then we have how much they're paying in taxes. And we have the net worth chart, which shows that basically by the end of this plan, all that's left for them is their real asset, and that they've depleted all of the other investment accounts. And all of these charts are available in the reports, which is the third section here, the client report. If I was to click on that, I can use these check marks along the left-hand side to indicate which report pages I'd like to include. And I can click any of these given pages to make some updates. We have an assumptions page. All of these pages have comments below that you can add information. And then we have our charts that we just looked at, and then more tables to include as well. And we have a lot more information about how to present the report. If we come back to our webinar section, this is a great resource for all the different features. We pretty much have a webinar for each feature, including how to present the projections to your clients. So I'm at about 35 minutes after the hour. One thing I will mention, and I'll just check if there's any additional questions that have come in, is since we're almost at the end of the year, we have a feature that you're going to need to use as you get started next year. If you've created any plans in previous years, so in 2022, for example, I had this original plan for them. You can see that when I come into this planning page, it's asking me to rebase the plan. So it's saying the scenario cannot be edited because it starts in a previous year. You can see here it's starting in 2022. So please rebase it to the current year. And we have a rebase scenario up at the top. So instead of running the scenario, you have to rebase the scenario. So I can click that. And this tells me a little bit more information about what happens when I rebase the scenario. We're going to be taking all the end of year values from this plan and putting them in as the start of year values for the new plan. So in this case, we rebased it to 2023 because we're still in 2023. After the new year, we'll be rebasing things to 2024. I can also come into the scenario setup again in the general page and change the year to start in 2024 if I wish. But all of the information was taken from the 2022 plan, and these values were updated based on the projected end of year balances from my last projections. So if I would come in the new year with actual values, and I can just adjust these to what actually happened. So that's the rebase scenario functionality that you'll need to use in the new year. I don't see any additional questions here, so you can always reach us. If we go back to the help center, here's our phone number up at the top, and as well as our contact information. You can send us an email. But yeah, please give us a call, and if you have any questions, we're happy to take a look at your scenario with you and join us for future webinars. Thanks a lot for coming today. Appreciate it. Have a great day. Thanks a lot.